Hello, my name is Dr. George Machaki, and welcome to Finance 225 International Finance. Today we'll be covering Chapter 5, Currency Derivatives. You're either taking me in an online class or a face-to-face class at Harper College. And this is a supplemental to the reading material, to the book that is required for this course. It has all the information. You have access to these conceptual maps or mind maps in Course Management System Blackboard. So the recommendation, I'll do real quickly because we're in Chapter 5. I go over this every time just to make sure. You will read the book. Before you read the book, print this out. You're at the second level of my mind maps and the PDF files. Read the book. Look how far I've provided the information I provided for you. Add on to it in your own words. And then later on, after in lecture or in the discussion group on the online class or in the lecture in the classroom, you will see, add on more to it, and then look at this as your last summarization of the material. I'm going to go fairly fast. I'm just going to point out the main points. I'm not going to do. I'll try to explain a little bit. I'll have other YouTubes or short videos on how to do certain math problems. I'm trying to keep this summarization, a quick overview, down to an hour. I've been running about an hour and a half because there's a lot of information. Most of you, the requirement for this course is you already had a couple of the two basic accounting classes, and you had corporate finance as a prerequisite to this course. So you already have some general information. So I'm not going to go back down there and explaining some of the formulas because this is, as I mentioned before, just an icing or the next level from corporate financing. Okay, so and the other thing I just want to mention, at Harper College you have the access to these all my lecture or these summarization flip the classroom videos in Harper iTunes U. Utilize that. It's and if I'm a little confusing, there may be another instructor teaching this that also has videos posted on there. So try to use between all that. You should do pretty well. Okay, so let's go into currency derivatives. Now remember, follow along with the concept maps. This is just a supplement. If you never read the book, there's no way you're going to understand this. And as I mentioned before, my main focus in this class is for you to learn a new terminology. This is an introduction class, for lack of better words, to basic understanding at a community college, so it gives you a good, solid foundation. But you're not going to just learn everything else from here, because I'm just going to bring out the main idea. So there's something that's a little confusing when I say here's what's happening to this strategy and you don't understand. Go back to the book. The author did an excellent job. He has examples. There's examples in the back. There's supplements. You have a linkage to the book. You purchase the book. You have a linkage in there that will give you additional help. So make sure you utilize this. This is just a quick overview when you're studying for the exam. You think, what do I need to know? All right, so currency derivative. Now you had a little bit of that in corporate finance. Let me just get that. What is a derivative? Okay, a contract whose price, and I have this in here, so remember, just add on, and I put on a little more words than those of you who are familiar with mind maps. So you're taking this, you somehow stumbled across this at a YouTube. Make sure you sign up for the course and or look up different ways. This is just a quick overview. Basic definitions: a contract whose price is derived from the value of underlying currency. And you get a different derivative, but this one is looking at currency. Okay, currency derivative. Now some examples would be forwards and future contracts. This is what we're going to be discussing in this class. Okay. In this chapter, and speculated, when I'm looking at MNCs, multinational corporation, the whole focus of this first half of the chapters, from chapter 1 to 10, is going to be looking at through the eyes of a macro. So we're looking at the global implications, how multinational corporations, for lack of better words, buy future contracts, or forward contracts, what we're going to be discussing in here, different currency options, from a multinational corporation's perspective. This strategy could also be used for small business or medium businesses that are going to go into the global arena, just to have a general idea. What I want you to learn out of this course that I'm teaching at a community college is the basic verbiage. The math, you're going to be doing homework problems and everything else. Most of the tests is so you understand the concepts. There's a lot of new terminology, a lot of new concepts that you have to build on. So when you take this course at a bachelor's level or at a master's level or even at a doctoral level, you just go higher and higher. But you already know the language, you know the terminology, and now you're going to then you're going to be focusing into more into the math and the equation. Even though the author supplies a lot of this, and I'll talk about that in our lectures, but there's no way I could do this. Okay, so MNCs, multinational corporations, speculate on future exchange rate movements because I can make money on that, buy them or sell them, and hedge exposure to the exchange rates. Okay, now let's talk about the forward market. What the heck is a forward market? Now, you're going to have forward contracts. You're going to see how MNCs utilize the forward contract, what a non-deliverable, or what the author NDF forward contracts, and premium or discounts on forward rate and arbitrage. Okay, so let's look at forward contracts. Remember, you're following along. This may not make sense to you. You have to read the book. There's no way you're going to learn this without reading the book. The book has examples. Anytime you're learning finance or any kind of math class you're taking, you have to actually sit down and you're just not going to skim it one time and understand it. My whole thing is over and over. You've done all this, and now we're just kind of summarizing it in the basic way. Okay, it's an agreement between a corporation and a financial institution. Okay, to exchange a specific amount of currency at a specific exchange rate called forward rate. And you're going to find out, remember, in finance, if you learn in corporate finance, and even international finance, a finance manager is also looking at terms and conditions. What are the terms and conditions? What are the rules that I have to play by? Okay, so at a specific exchange rate called the forward rate on a specific date in the future. Movements in the forward rate over time. The forward premium, that's something I received, is influenced and can change over time, like anything else. Because we're looking at currencies, and looking at exchange rates, and you're trying to hedge or trying to protect your organization for what you anticipate is going to happen in the future by the interest rate differential between two countries. Remember, we're at a macro level. Okay, now how do MNCs use forward contracts? Okay, they hedge it. Their imports by locking in a rate at which they can obtain the currency. Remember, I'm going to lock in the future. The future is, there's things going on and stable or very active, whether in a bear market or in a bull market, and it's still the same concept applies into the international market. So how do I lock and protect? That's my job as a financial manager, chief financial manager. What's my strategy? To make sure that I either break even or to hopefully make money. Okay. Now, bank quotations on forward rates. The bid and ask spread is wider for less liquid currency. I'm not going to go through this bid and ask. I've already had in previous chapters. May negotiate an offsetting rate if the MNC enters into a forward sale to something in the future and a forward purchase with the same bank. So I'm buying and selling at the same time. So I'm trying to, for lack of better words, trying to negotiate so it comes out, at least I break even. Hopefully I'll make money on this one. And offsetting a forward contract, MNC can offset a forward contract by negotiating with the original counterplay bank. Very good, okay. Now, using forward contracts for swap transaction involves a spot transaction, means right now, along with a corresponding forward contract, something in the future, that will ultimately reverse the spot transaction. So I'm doing something now, but I have something in the future that may ultimately reverse the spot transaction, depending what my strategy is, depending on what the spot, the rate's going to be at that time. Okay? Now, we're going to talk about the next one. Remember, you have to read the material. I keep on stressing that. This is just, oh yeah, now I understand it. Or I don't understand it. Go back to the book. Look at this thing. Because if I look at my mind maps, it follows what you're reading in the book. It just gives you added information. This is kind of like a real quick outline. So when you're studying for my exams, you say, how do I study? There's a lot of information you're learning, but I try to put it in 2 pages in my mind map, so when you're studying, you can look at it. Okay? Now, non-deliverable forward contracts, or what they call NFDs, I'll put that in my, can be used for emerging markets, currencies, new developing countries, where no currency delivery takes place at settlement. Instead, one party makes a payment to another party. Okay, get rid of that. I was clear, right? All right. Now, premium or discount on forward rates. This is the formula. F equals S 1 plus forward rate. Okay, the spot, the forward premium. Here we go. So here, I've got the map. I've got this. Look at the chart. I can't go into the chart here because a lot of information. I'll be here for a couple hours. But here's the spot rate. Here's the maturity date, and here's the formula. You know, F is the forward rate, S is the spot rate. Okay, and P is the premium or the percentage by which the forward rate exceeds the spot rate. So you have this. Look at that forward out. There's no reason for me to go to it. Remember, you can stop the video right now. Look at it and try to understand what's going on and follow the map. Okay, so the examples are there for you. Okay, average. Now let me give, if a forward rate was the same as the spot rate, will be covered. Okay, what I'm saying, we're going to have this in chapter 7, a couple of chapters in chapter 5, but they're talking about it here, part of this lecture. You'll be more understanding average down the road. There's a whole chapter on there, a little more in depth. There's no reason that. So those of you who say, hey, I really want to know this, flip up in the book to chapter 7 and read it, and then you'll be ahead of the curve. Okay, but if I look at the average, the basic definition is capitalizing discrepancies in the quoted price by making a riskless profit. Many cases, no risk. Remember, when you look at this, no risk, risk and does not require funds to be tied up. It'll make sense after it's just regular definition of average. It'll make sense when we go into it, and I'll go a little more detail in chapter 7. Okay. Now, currency and future market. Oops, let me just close all these off here. This way I won't have any. Remember, you could always look at this. You stop it. I just want to go through all of this. And some of you, when you're studying, you know, there's a lot of information I have here. Okay, so if I'm looking at this, similar to forward contract, in terms of obligation to purchase, remember, forward something in the future, or sell currency at a specific settlement date in the future. You always have what is the contract, what's my the rate, and it's always in the future. What's the date in the future? Okay, contract specifications. Remember, we're dealing with currencies in the future market. Contract specification differ from forward contract because futures have standard contract specification. This already tells me what the contract lays out everything in there. Standardized number of units per contract. And see Exhibit 2. Let's see, here it is. So if I really have, here's the contract, you know, the different euros, Japanese yens, Korean won, you know, peso, the New Zealand dollar, Norwegian krone, you know, the Swati, ruble, rand, krona, franc. Just look at that. You know, these are future contracts traded on the Chicago Mercantile Exchange in Chicago. Remember, they have a nice site, and later on, utilize the sites that's been supplied by the author. We've already used them before, or there's a link in my Blackboard course management for all these. The Chicago Mercantile Exchange, nice. You can look at it. They have their own site to give you some information. Okay. Now, we have this. Offer greater liquidity than forward contracts. Remember, liquidity is how quickly I could turn it into cash or sell it. Typically based on the U.S. dollar. The whole thing may be offered on the cross rates we talked about before. Commonly traded in Chicago Mercantile Exchange. Okay, now trading currency futures. Again, trading currency. I'm a multinational organization, so I have to have currency from another country, and I'm trading it. How much do I hold? How much do I have available? What's the exchange rate? Everything we've talked about previous chapters. Overview, real quickly, just to kind of focus you in a little bit. Firms or individuals, you could do that too, can execute orders for currency future contracts by calling a brokerage firm, and there's a whole list of different brokerage firms. Trading platforms for currency futures. Electronic trading platforms, you already had that, facilitated by trading currency futures. These platforms serve as a broker as they execute the trades desired. Okay. Now, comparison to forward contracts. Currency future contracts are similar to forward contracts, and I have an exhibit here. Now you can look at the size of the contract, standard, security deposit clearing, marketplace, regulation, information. Okay. Now you can stop this, look at it, but I provide this. Remember, if you just happen to run across me on YouTube, try to sign up at the course that I'm teaching, FIN225 at Harper College, or if you're at a community college, they may have a different nomenclature, but if it's international finance or international management finance, sign up. This will this will help you a little bit. But if not, stop the video, look and read this all through. I can't go through all this. You're at a college level, you should be able to look at the information and use the book as your resource. Okay? Now, pricing currency futures. If I'm looking at pricing, price of currency futures will be similar to the forward rates. Okay, we talked about that. Credit risk, remember this is a summarization, not sure, go back to the book. Credit risk of future contracts. Okay, this will be easier. What do we have in here? Is to minimize its risk. Chicago Mercantile Exchange imposes margin requirements, no different than you're doing, as you've learned what the Fed does with certain margins. And this is margins, how much do I need to put down, for lack of better words, to cover fluctuation in the value of a contract. Participants must make a deposit with the respective brokerage firms when they take the position. Finally, when I submit, I want to do this, or take the bid, Okay, how firms use currency futures. Now, there's three main ones. I got them in bold. Make sure you remember this. They may come up on the exam. Okay, purchasing futures to hedge payables. Purchases of future contracts lock in the price, so I'm already saved, at which a firm can purchase the currency. I'm hoping it's going to be there. I don't want to lose money as a finance. I want to make money. If I lock it in too high, how do I get rid of it? And sometimes you may want to do it because remember the market changes over time very quickly, especially in the international market. Look at how much is happening in the domestic market in the U.S. Think how much is happening globally. You have different markets, different areas, different countries. A lot of things are going on. We've covered that in previous chapters. Okay, the next one, selling futures to hedge receivables. The sales of future contracts can lock in the price at which a firm can sell a currency. Different strategy. Okay. And then the last one, closing out futures position. Sellers, or what we would call buyers of currency futures, can close out their position by buying or selling identical future contracts prior to the settlement. Most currency future contracts are closed out before the settlement date. Doesn't mean you're already taken care of it before it, but in case it doesn't, it depends on what's happening with the currency. Depends what's happening in the international financial market. And here's your formula. And you have the formula. I'm not going to go on closing out futures. Your contracts are buy, tells you settlement date. You have everything you're looking at. Okay, so you got these two contracts. Okay, and what's my loss? Right, I have one to buy, one to sell, and I lost in this case. Okay, but I didn't lose too much. Hopefully, if you're a financial manager, you don't want to lose anything. You always want to make money. But it depends. You're trying to. You're not a fortune teller. You're just looking at historical trends, and that's what you with the other sites. And if you've been in the business for a while, trading currencies and futures contracts, you already have a general. You have a feel. I'm not a speculator. Speculator, a little different. Speculators looking real quickly in and out. I'm going to buy and do. I'm a multinational corporation, and I'm doing the future to protect the overall risk or risk management for my organization. Okay. Now, speculation with future. Now, these are speculators. Formulas again. Here's one gains to some buying formulas. Okay. Now, when I'm looking at speculators, sometimes purchase, attempting to capitalize on their expectation of a currency's future movement. They're really watching, they're looking, but see, it's like anything else. If you've taken corporate finance and the instructor says, I want you to follow so many stocks, or the stock, And why did you do the stock? And people who follow in the stock markets, they're basically, they know historical. Here's, it's quiet. They have so much sales, selling, buying, but all of a sudden there's a spike. That's where you tune in. What's going on? Or you see something going on. What's going on with the company that you own the stock? What's going on with any kind of legal ramifications or new rules or procedure to may affect the stock? What's going on? Some kind of merger. So the same thing, even though it's not stock, the same thing. You can't just look at just what's happening with the currency. You have to look at what's happening at the total environment. You have to understand, here's what's going on, and now here's how I react. That's how my strategy. But I'm looking in the future. Same thing with the Federal Reserve. Are you going to raise the interest rates or the discount rate here in the United States? Everyone's looking at it. International market look at it. Because if they raise it, now it's a good thing to come and invest and buy securities here in the U.S. because I get a bigger return. Right now they're flat, so I'll go to European Union. I'll go, a lot of them went to China. There's a kind of a warning with China because China was having some problem with the stock market. So the investors are going, let's look at it. But are they going to come around that? Will they rebound? And some people, remember, are you in the short term or in the long term haul? If I'm looking short term, most companies are looking within a year, especially with currency because it's so hopefully right now in the market it's very unstable. Okay, so attempting to capitalize on expectation, often sold by speculators who expect that the spot rate of a currency will be less than the rate at which they will be obligated to sell it. Right? They want to make some money on that. Right? Now, efficiency of the currency of future markets. Remember, this management, finance, and chief finance. How effective or efficient is the currency future market? And how do I measure that? The continual use of a particular strategy. The future prices should reflect all available information, everything, all external forces, would not lead to abnormal profit. I don't mind the abnormal profits, but I can't strategize. I mean, I just lucked out. I bought the stock. Ooh, all of a sudden I didn't know it went up, or I bought this currency at this price, and all of a sudden something happened and went up. Look how many people locked in the future contracts in oil. And now oil price, who would think it's going to be down? I think it's now down to $2.67, which is fairly close to $3 a year, or going up to $4. Some say may even hit to $1.50, $1.40. I'm locked in with this thing because I'm buying on UPS or FedEx. I get a future contract for the oil because I thought the oil price is going down, but they dropped in reverse. Now I'm stuck with this. All right? But, so now do I do a future contract with oil for 6 months, 3 months? I have to understand all environmental forces. That's what I'm trying to say. So what has research found? Now research has found the efficiency that currency futures markets may be inefficient. Patterns are not necessarily observable until after they occur. Remember, I didn't know the country's going to go over. I didn't know they're going to be something's going to happen with the country. All right, means that I didn't know there's going to be that much unrest in the Middle East that's affecting all this. Who knew what's going to happen with Iran? That now they're going to lower the embargo that they have, or the restrictions they have for them with the currency. Now they have extra cash. They want to rebuild their economy. Hopefully, that's where they're looking at. So now they have all this extra cash. How do I put the oil in now in the market? So that's what they're kind of predicting, that the oil prices may go down. Means that it may be difficult to consistently generate abnormal profits from speculating in currency. If I'm a speculator, that's good. But I want to make sure that, I want to make a profit, but I don't want these big jumps. Because remember, it could be in reverse. I could lose money if I'm not watching. So as an investor or a chief financial officer strategy, I have to look in the long term, and I have to look what's going on here, and I have to see what's the story, what's really going on. Will it settle down? Will the market be calm? Remember, you're I don't want to say gambling. You're using historical data. You're using all the information, and you're trying to make a judgmental prediction of what's going to happen within the next 3 months, 6 months, or within a year. I even give up within longer than a year, because who knows what's going to happen in a year. So many changes happen. Okay? Okay, so now currency option markets. When I look at the definition of a currency option market, okay, provide the right to purchase or sell currencies at a specific price. Okay, now here's just some. I'm not going to go into options exchanges. Amsterdam, Madrid, Philadelphia first allowed trading in standard foreign currency options in 2000. I mean 1982, and it may be on your final. Okay, in 2007, the Chicago Mercantile Exchange and the Chicago Board of Trade merged to form the Chicago Mercantile Exchange. Just nice little trivial information. Exchanges are regulated by the Securities and Exchange in the U.S. And I had to do this. You should already know SEC from business classes you've taken, from accounting, from finance. Okay. Now, over-the-counter market where currency options are offered by commercial banks. Banks and brokerage firms. Note, unlike currency options traded on the exchange, over-the-counter market offers currency options that are tailored to specific need of that firm. Remember the note, so just remember that. I'll make that here. So next time you read it, it comes out. Okay. Now, currency call options. General grants the right to buy. I'm calling it in, right? I'm asking, like eBay, and then call it buy. Okay, to buy a specific currency at a designated strike price or exercise price. Okay. Let me just get this real quick. I'll leave that in here. Just excuse me. Okay, with a specific period. Sometimes I like to adjust stuff while I'm going because we're live. And those of you looking at this recording, I'm not reading off a script. I'm just going off of this. Remember how you utilize maps. How do you learn concepts? I read it. Just one senses. I write it. Another senses. I hear it. Three senses. The more senses you could involve, and I really love it. My emotion. The more sense I could involve, the higher probability of you retaining the information in your taking it from short term, putting it in your long term memory. So when you need it, it comes out easier. Right now, there's a lot of information. Your head's probably spinning, but you will do well. This is for many of you. This is your first exposure or second or third exposure after reading it, lecturing, and looking at this. I'm trying to utilize all senses. That's why I'm just reading it. So read along with me, stop it, learn it, and move on. Or replay it a bunch of times when you're driving. If the spot rate raises above the strike price, the buyer of a call can exercise the right to buy the currency at the strike price. The buyer of the option pays a premium. Okay? Now, if the spot exchange rate is greater than the strike price, the option is in the money. And it makes a little more sense. It's in the money, the dollars exchange. If the spot rate is equal to the strike price, the option is at the money. I'm looking at it. I don't have it yet. Okay, if the spot rate is lower than the strike price, the option is out of the money after I purchase it. Okay? Read it. I'm already running a little bit. I'm doing good. Okay? I'm doing good. Okay? So now factors that affect the call option factors. Remember, always look at it. We're looking at currency call option. Last one we're looking at. Remember, we're looking at the currency future market. You see how I'm going? And now we're going at the currency call option, right? Look at it. And remember, you could always print out certain sections. I have to see how I'm going to do that. Okay, call options. Okay, so I've got that spot rate. Currency call options. Okay, the decline price spot rates. Okay, here we go. General grants the right to buy specific rationale. I won't go back because there's so much information that might have lost my place. If the spot rate raises above the strike price, the owner of the call can exercise the right to buy the currency at strike price and pays a premium. If the spot exchange rate is greater than the strike price, the option is in money. Okay, we went through this. Okay, factors affecting the call option. A reinforcement is fine. All right. Now, factors affecting the call option. Here's the formula. Okay. And a premium on the call option is C, affected by three factors. Okay. And then the spot rate. Let me just put this on there. One, just three things that affects it. The higher spot rate relative to strike price, the higher the option price will be. Makes sense. Okay. Now the two is the T. The longer the time to expiration, the higher the option price will be at more time. Okay. The potential variability of a currency, the sigma. right? The greater the variability of the currency, the higher the probability that the spot rate can raise above the strike price. Okay, now how do firms use currency call options? They use it for three items. So if you see this, look at this. To hedge payables, to hedge project bidding to lock, let's see, in the dollar cost for potential expenses. Remember, you're looking at different countries. How do I lock these in? All right, the currency call options. I want to always protect myself. To hedge target bidding of a possible acquisition. Okay, now speculating with currency call options. Individuals, let's go, may speculate in currency option based on their expectations of future movements in a particular currency. Remember, I'm not one in looking at guesses. I'm looking at critically look at information, understand the market, see, and you're doing at intuition. Now, intuition, we all have that intuitive. Those of you who've taken me in management or marketing or something, I stress that you use that little voice inside you. Something's not right. That I don't know what it is. That's just a red flag for you to look at it. Check into that area. Where do I look at? Oh, I think it's over here. Remember, just if you lost something or you're trying to find out something, you're using that intuition. But you're using that intuition from your past experiences. Now utilize. Don't knock it out. It's just it's not guessing. Intuitive. Intuitive means it's in here. It just hasn't brought out. Something inside of you is telling you something because you already had that information stored. And it's going, I haven't really found out. I have to fine tune. There's something here. It just doesn't look right. Or something here. Man, I'm missing something. Intuitive development that every finance manager, every manager, everyone should have. You have to have that intuitive. You have to. I especially stress on that. A lot of as we're growing up, he says that's just imagination. Don't do that. You have to have all bare fact. You can't. You're doing it in the future. I don't know. I can't have a crystal ball. I'm not looking at that. I'm not a mind reader. I don't have a time machine to see what's going on. If I did, then I'd be a millionaire, more than a millionaire, because I already know what's going to happen in the future. So I know. But so now you're using all your expertise, everything else that you know that's in here, because you're following the market and you're taking. Some speculators, that's what they do. But some of them are better than others. Even the good ones will lose it all, and hopefully they'll come around it. All right. Now. Speculators expect that the foreign currency will appreciate. Let's put that in here. Can purchase call options on that security. Okay, now the net profit comparison of selling the price for the currency versus the exercise price paid for the currency and the premium paid for the call option. Remember, I'm paying for something, I have to pay a premium if added. Okay. Now the break even from speculations, if the revenue from selling the currency equals the payments made from the currency plus the option premium. That's my break even point. I have to put that in, or in finance, you're looking at my yield. Everything that's touching. What's the bottom line for when do I break even? And once I break even, what I invested, anything above is my profit. Anything below, I'm losing. I didn't break even. Okay, now, and depending on your organization, they have different break-even points that they're looking at also. Okay, now speculations by MNC, multinational corporation. Some institutions may have a division that uses currency options to speculate on future exchange rate movement. That's their whole life. They're watching it. Okay, most MNCs use currency derivatives that we talk about for hedging, and not for speculation. Remember, I don't need that at normal profit. I don't do too much on speculations. I'm not. Sometimes it happens. Some may. I'm not saying all firms. Some firms do, but the majority are basically using currency derivatives for hedging. It gives me a little more control. Not much more, but it's more rational, for lack of better words. Okay. All right, we're moving along pretty good. Oops, I lost it. What did I do? There we go. A lot of information here. Like I said, the book is well written, even though it's small print. a smaller print, put on your glasses, or if you could get an electronic version of the book, you can make it larger. And I think the author does, or the publisher does present an electronic version for those, so it's easier. And then if you got the websites, it all links on there. I think that's most of the publishers are going in the future. It's all going to be like an ebook. You just download it because you have a lot more options. You have a lot of color. You could adjust it. You could cut and paste. You could open up the links right away, and it makes more sense. I didn't put any web links in here in this chapter because I'm trying to see if I can make it underneath an hour. Okay, so now let's look at, let me just close all these. Currency put options, I just close all these up. Okay, then we could just discuss them a little bit easier. Hang on a second. While you're following along, remember you can always stop the video, look at it, and go. Okay, so what's the definition of currency put options? Grants the right to sell a currency at a specific strike price or exercise price. These two are interchangeable, right? One or two, it's interchangeable. All right, let's leave it there. With a specific period of time. You already know it. Everything else is what's the price, sell a currency, what's the strike, what's the exercise price, and what time frame do I have to act on it. Now the rationale on this, okay, check marks, most likely focusing on this. If the spot rate falls below the strike price, the owner can exercise the right to sell the currency at the strike price. Okay. Oh, sorry. This one gotta go right here. Okay. That takes care of that. Now, if the buyer buys option, pays a premium. That's just in the middle. Remember, if the buyer the option has to pay pays a premium to the seller. Okay. If the spot exchange rate is lower than the strike price, the option is in the money. Okay. In the money. If the spot rate, and look at the book, the author explains it, and if you look, even if you're not sure, hey man, this author's not coming right, there's other information. You have the internet. You could go into Yahoo Finance. There's a lot of other things. Go into the Chicago Mercantile Exchange and look at them and look at their definition. They'll give you the basic definition, motley.fool, for lack of better words, another one in everyday language so you understand it. But in the course, you have to understand the terminology that's used. That's why I'm very focused on the terminology. If the spot rate is equal to the strike price, and you got you could do a lot of information. There's even YouTube. There's other instructors online. As long as they're from a college level, that will explain just that one specific thing. What's the spot price? If the spot rate is equal to the strike price, I don't understand it. Put that in there and see how someone else may explain it in their own words, and they click to you. There's no way. You have this vast amount of information out there in different ways of looking at it, in a different verbiage, and breaks it down different by different instructors, different authors that discussing it, or different. Make sure it's a credible site, though. Okay, if the spot rate is equal to strike rate, option is at the money. If the spot rate is greater than the strike price, the option is out of the money. Okay, what I get out of it. Factors affecting currency put option premiums. Here's the formula, and I'll just put this in. Okay, and here's when you really have put option premiums are affected by three factors. Okay, spot rate, the spot rate relevant to the strike price. The lower the spot. Okay, remember, let's get this. The lower the spot rate relative to the strike price, the higher the probability that the option will be exercised. Somebody will accept it. The longer the time to expiration, the greater the put option premium. Okay, that's someone's got to pay. Variability of the currency, sigma. The greater the variability, the greater probability the option may be exercised. Okay. Hedging with currency put options. Corporations open positions in foreign markets can use currency put options in some cases to cover these positions. Some put options are deep out of the money. Prevailing exchange rate is high above the exercise price. These options are cheaper, have a lower premium, unlikely to be exercised because the excess price is too low. Okay, so they have a lower premium. It's one way of minimizing risk. Okay, other put options are have an exercise price that is currently above the prevailing exchange rate and therefore more likely to be exercised. It's higher than exchange rate, as long as the exchange rate doesn't go up. Okay, these options are more expensive. Speculating with currency put options. Okay, we are ready. Now you have to. These are all main topics. The book addresses each one in a little more detail. Again, if not, go outside, look outside, discuss it in our lectures. Okay. Now, individuals may speculate with currency put options based on their expectations of future movements in a particular currency. Speculators can attempt, remember, looking globally, many countries, depending where you're trading, depending where where a multinational corporation is working through, okay, or if you're an individual, like with stocks, you're going to find, there's global, which ones am I comfortable before I expand. Same thing, multinational, open up in one country, they're trying to find a similar market or something closer because they have the distribution. Same thing when you're looking at this information. You're not going to do the whole world. Remember, we had all those. How many they had listed up there? About 100 different currencies. Which ones are you looking at? Which ones are you trading? Which one gives me, as a chief financial officer or a strategy and finance, a higher return in my investment, or at least minimize? I'm already operating in that country for either exporting or importing, or have direct investments there. So, for lack of better words, made the investment tied in securely in that. I don't want to say stuck, but I'm in that market, and like any market, you ride through the different cycles going through. Okay, so speculators can attempt to profit from selling currency put options at the strike price from the owner who exercises the put option. Sellers of such options is obligated to purchase the specific currency. You have no choice. It's like that. And I always use that thing as eBay. They put it on there. Once you said, yes, I got the bid, I'm obligated. If I don't, they knock me out. But there's some penalty. Just leave it at that. Okay, the net profit to speculator. Based on the exercise price at which the currency can be sold versus the purchase price of the currency at the premium paid for the put option. Tongue twister. Okay, speculating with combined put and call options. So what they call straddle uses both a put option and a call option at the same exercise price. Good for when speculators expect strong movement in one direction or the other. They're not sure going one way or the other, so they're kind of covering their investment. Efficiency of currency option markets. Research has found when transactions costs are controlled for the currency option market is efficient. I control the transaction costs. Difficult to predict which strategy will generate abnormal profits in the future. I want those abnormal profits. I want to make that big return on my investment. But can I do that every time? I may, sometimes it's good, but sometimes I could lose because it may not move the way I'm speculating. So a lot of companies, multinationals, don't like doing it. They like to at least have a good handle on that. So they know the revenue's coming in, the revenue's going out. I want to always making a profitability, always trying to increase my return on investment. Okay, so now let's go up here. We got a few more in here. Okay, contingency graphs for currency options. Now, the way I did this one, they have a big graph in here. I've showed all the graphs in here. When you look, I think it's graph 7. It has 4 graphs when you read it. in the book, but I just did it. Okay, contingency. So here's the graph. As part of this, I just want to put it in there. It'd be forever, so I adjusted the constant graph. Contingency graphs for currency options. Okay, contingency graph for a call for the caller of a call option. Compares price paid for the option to the payoff purchaser received under various exchange rate scenarios. And here's the graph. Remember, I'm just going to go open it up, stop it, look at it, figure it out, see what's going on. Going up, okay. Contingency graph for seller of a call option. Okay, compares the premium received from selling sellers the option to the payoffs. And here's the graph. Okay, look at it, stop the video, and scan it and see, does it make sense? Okay, contingency graph for the buyer purchaser of a put option. Compares the premium paid for the put option to the payoffs received under various exchange rate scenarios. Graph purchaser put, and here's the put. Remember, some of you, if you forgot it, stop it, look at it. Okay, contingency graph for the seller of a put option. Compares the premium received for a put option to the payoffs made. The graph again. So I open the graph so you can look at it, and you can look at it. What does it mean? Okay, and if that doesn't make sense, then again, go into the book, read it. There's information. There's examples in there. I'm over here glancing to the left of my clock. I'm already at an hour. Okay, so let's see. Conditional currency options. Okay, what do we have in here? And I have an exhibit here. Okay, follow the graph along. Where is it going? Put, basic put, condition and put. Moving which way? Up or down. Okay, got the basic information. Comparison on basic currency option. Indicates that the premium paid for the option is conditional on the actual movement in the currency over the period of time. Firms also use various combination of currency options. Okay, so look what's happening. Where did it go? Okay, now European currency option must be exercised on the expiration date. Boom, no choice. European currency option, EU, on the, if they are to be exercised at all. They do not offer as much flexibility. However, this is not relevant to some situations. Okay, and here's a scenario. If European-style options are available for the same expiration dates as American-style options and can be purchased for a slightly lower premium, but I have to pay for it, some corporations may prefer them for hedging. Remember, I'm keeping this to utilize it depending on what happens in the market going forward. Okay. Whew, we did that. Almost done. Okay, now let's look at the summary. I'm going to give you a real quick summary of the whole chapter that we went. Forward contract specifies the standard volume of a particular currency to be exchanged on a particular date. They all have that. Contract may be purchased by a firm to hedge payables or sold by a firm to hedge receivables. Either one. What am I using it for? What's my strategy? Depends on your organization, depending what you want to do. Okay, currency future contracts can be purchased by speculators who expect the currency to appreciate more in value. Can also be sold by speculators who expect the currency to depreciate. They're not going to tell you, why are you selling? No, I'm just selling it. I had this feeling, or I know I got some information that something's going to go on with this currency. I've been tracking it, and historically this is what's going to happen. Okay, so if the currency depreciates, then the future contract declines. Speculators to benefit when they close out their positions, holding it. I sell it, get rid of it before time. Either sell it or I buy it ahead of time. Okay, currency options. Classified as a call options or put options. Call options. The owner gives the owner the right to purchase a specific currency at a specific exchange rate by a specific expiration date. Purchased by speculators who expect the currency to appreciate that have payables in a currency. Put options. The right to sell a specific currency at a specific exchange rate by a specific expiration date, purchased by corporations and commonly purchased by corporations that have receivables in currencies on a specific currency, expect that currency to depreciate. Okay? So when I look at that, we have everything in here. Hang on a second. Let me just put this in. All right. So we covered everything. We covered currency derivative. We covered forward market. We covered currency future market. We covered currency option markets. We covered currencies call options. We covered currencies put options. We covered contingency graphs. Just here, look at them. Conditional currency options and European currency options. And then you have a quick summary. Again, you did. There's a lot of information, a lot of verbiage. You'll do well in the exams. I will help you. You remember, you will do homework where you do problems here on the exams. And at this level, I'm not going to do too many problems. In your midterms and your final exams, the problems will be all done in class. I'm more concerned out of this course that you know what a currency derivative, you know what a forward market is, you know what future markets are, you know the different terminologies of options, so you have a general idea. Remember, we're only in chapter 5, and we have, let's see, I think there's 20 chapters or 21 chapters. We have 16 more chapters to go, 16 more definitions, 16 more terminology. Utilize these concept maps, save them, print them out with your own verbiage. They are a good source to study. They're a good source to remember. I'm not sure if in some of my classes I may allow you to utilize some of your concept maps or some basic notes, because there's just so much information. You right now are learning a language of international finance, which every business person, if you're going to, so you at least know the terminology, you know what's going on. All right. So again, my name is Dr. George Machaki. This is Finance 225, International Finance. We've covered Chapter 5, Currency Derivative. It's just an extension of what you've learned in corporate finance or a business math courses you've taken. I think they touch a little bit in accounting 1 or 2. All right, then we've touched a little bit about it in an international section if you've taken some business classes. Again, I'll see you in the next section. Bye. And I hope I'm under an hour.